welcome to the closing beat, everybody. Happy Tuesday to you. How you doing out there? What's the deal with Christmas songs? We were just talking about that. Are songs like that like copyrighted? Like a general Christmas song? Like if I wanted to sing Jingle Bells or something? I don't know. Anyways, we do numbers around here. We're financial advisors while other advisors play checkers. We are playing chess. A great example today was a client that I've been working with here off and on, got a little more serious lately. And we figured out that they need to retire sooner than they want to. Not because they can, but because they end up with more money. And I thought that was cool. You don't come across that often, so it was kind of like, hey, I know you set the bar here. I need you to go here, or it's going to cost you to keep going. And yeah, that doesn't always happen. So check us out at jazzwealth.com if you want to hang out with us this Thursday, Wine and Wealth. We do a class every Thursday. We call it Wine and Wealth. You know, you just hang out and get a little loose, talk about some strategy and stuff. And this week, we're going to do the rich people's strategies when it comes to donor-advised funds and how you can participate in those as well. A lot of people think like, I don't got enough money. I don't want to donate to charity. Oh, no. That's not the game plan there. Well, I mean, you want to give to charity, I guess, if you can, but that's not the game plan there. We'll go over it. Anyways, let's take a look at the stock market. By the way, have you seen DocuSign? God, out of nowhere. Haven't looked at it recently. It is Fed week around the world, right? We had inflation today. We should probably talk about that first, but then coming up, we have the Fed announcement. There is a 100% chance, basically, that they are not going to change rates. They're going to leave them just as is, so don't expect anything there. We're looking for wording in their announcement or in the press conference that has to do with, that revolves around maybe cutting rates sooner, however, not right now. So maybe we move forward to like third quarter of 2024, something like that. We'll see. They're sort of, they call it the dot plot there, kind of shows 2 rate cuts next year. And we'll see. That's coming out, so that's going to be a lot really for the U.S. Then we've got Japan and Brazil and everywhere around the world that's going to have their Fed meetings as well. Inflation comes in at 0.10% month over month, meaning it only increased 0.10%. It didn't increase 2% or whatever it is. My guess was 0.03% because I thought it would be relatively flat. I was trying to give it a few points. I should have gave it a few more. That puts the headline number for inflation at 3.1%. The target for the Fed is 2-ish, is what they're looking for there. If you want to know how quickly we could get down there based on various month-over-month projections, you can look at our notes from Jazz last week and check it out. I mapped out every single scenario for you. This one today would fall into the 0.1, obviously it's spot on, % increase, and so you'd follow that little line down to see if that continued to happen, when would we get there? Like I mentioned, we've got the Fed week coming up. We'll talk about that as it comes. Let's look at the S&P 500. That's officially 1, 2, 3, 4 days in a row that we have moved higher in a ever so slow and non-volatile way. If you look at the VIX, I'll use the ETF so you can follow along if you'd like. Very, very calm, right? Almost enticing you to come play the long side there, but be very careful if you choose to use options to do that. I speak from experience. Nonetheless, here's the S&P. We talked about that already. There's another day where we continue to see other areas of the market leading the way. Meaning it wasn't the big 7, and then their, supporting cast. If you look around, actually, you've got basic materials. Kind of a stealthy little rally that nobody likes to look at. It's a boring area. I get it, but that's something that needs to be pointed out. Financials carrying their own, helping the markets here. We didn't rely on Tesla and Microsoft and others. We get the big financials. The XLF is the ETF I use to show that. That would be the big names, right? That's not your small regional banks. Those would be the big names. They're doing their job there. And the worst of all of them is getting better by the day. Healthcare. Kind of known as the dog this year, one of the few dogs we'll show in a second there. But healthcare with a nice rally today and helping support its own, right? Looking at the Dow, if you want to go over to the Dow, you can say the same thing. So the Dow, where's all that support coming from? Well, you got to include some healthcare and materials in there as well. I like that, right? As a longer-term investor, you like broad participation. You don't want to see the top you don't want to see the top 10 stocks leading the way. You want to see that the market is being carried forward by a severe amount of optimism that is broad-based. Okay, it doesn't help if there's just a few big stocks that are doing it. So I'm happy with that. I mean, typical December type action there, but still likely, to continue in a lower volatile kind of a way there. All right, the S&P, like we talked about, the move today and that supporting move into some of those other areas, really healthcare in particular, a little early, or I should say I'm unsure whether this is official rotation or just a little sector year end, what they would call tax gain harvesting. You notice how you don't see a lot of tax loss harvesting talked about this year. This is the year of tax gain harvesting, where if you're working with an advisor or something, you're less likely to say, get me losses, and more likely to say, let me see how I can lock in some gains now so that maybe next year my income can be whatever it is. I don't have to worry about this going into next year. Maybe you had lower income this year, something like that, or have some itemized deductions that you weren't otherwise going to have if that applies. Now, S&P wise, all right, there you go. So this year so far, let's talk about this just a little bit. It has been what you would call a winner-take-all type year, all right? If we look at the performance year to date, not including today, of all the different sectors out there, 51% for the tech sector, communication services 48, and consumer discretionary 35. They're the ones that have started off the year strong. They went through the October pullback better than others, and they're finishing out the year strong. I'm from Texas, and so we have a lot of different sayings out there. The one that I remember most from when, well, I won't say. But one I remember the most is dance with the one that brought you. You know what I mean? That's what you have going on into the end of the year. Those areas, even though today was a little bit different, those that have done well year to date are carrying that momentum, even if it's slower, into the end of the year there. You got these three sectors up over 35%. No other sector is really up double digits. I'll give you the industrials because that helped a little bit today as well. But really, no other sector can promote double-digit growth. There's a big spread between the leaders and really everybody else, which you call the laggards there. If you look at financials, up about 5%, and today, after the performance today, you would say up 5% there. Nothing to be mad at. Basic materials up 5%. It's not a bad return. It's just not impressive when 10x is over here with, the tech sector there. Defensive stocks, most notable so far year to date. If we were to do a year in review kind of a thing, the defensive stocks have been the negative ones. That's obviously not good there. And I would add to that, if you're what can we do it here? If you're a dividend investor, use like the DVY or something. It's not bad. It's just underperforming. We talked about this yesterday a little bit with the dividend stocks, and people kind of really less interested today or this year because of more competition. I've got money market funds as a choice. I've got CDs as a choice, short-term treasuries as a choice, alternatives as a choice, weird alternatives that include a mix of all of those. All of that is a choice, and so I don't have to take that stock level risk when I could maybe put the risk over to the government or even corporates, things like that. So if we go back over here, the defensive area there, I would say not in trouble, but it's just that there's, shinier objects out there for people to invest in this year. I think a little bit of that will change going into next year. We do have, historically, the second largest, how do you want to say that? Between the gainer and the loser. It is the second largest spread ever in history, 51.4 versus negative 11 there. If you go all the way back so we go back to 1945, if you do the same thing for every single year at this very moment since 1945, the year 2000 is the only other time that we had a spread so large here. And actually, kind of funny, it's because tech was over here. Tech fell apart there. So kind of interesting there. And it's actually the first time, I just like stats, I don't know what to tell you. It's the first time ever that you have three sectors with gains of over 35% and four sectors that are actually negative. What does all that mean? Well, what we've been talking about all year long. The market has mostly been led in a very, 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 very big way by just a few things. Right? Obviously, just a couple sectors, but just a handful of stocks. It's very interesting for those of you that are saying, go chase those big stocks, Dustin. That's where I want to be. I'm talking to a lot of people, not just one of you. It's very interesting when you go look up the forward performance when those stocks have amazing runs. Go look at the forward performance when those sectors have massive double-digit runs. does it tend to continue? Is the opportunity to buy it now before you miss out on another 50%, or is the opportunity that there will be pullbacks, little ebbs and flows along the way that give you a better entry into what hopefully is forward momentum, right? Really think about that, because it is super, super, super easy to say, I like the way this looks. I want a piece of that. I may not get all of it, but I want a piece of it. Ask yourself, risk to reward. For example, gold. We talked about it right here on the big, what we're calling the middle finger day, just to kind of make light of it, really. And it's just fun to point out. But we're looking at gold and we're saying, if you were to fall for that momentum that day, or even if you saw it pull back and say, ooh, I missed it, but I got a second chance. What's the risk to reward? That is going to be the key wording you're going to use in a lot of these sectors going into next year. I'm using gold as an example, but let's do it. I'll go a little further. I'll use tech. All right, things are going well. Things look good. What is the risk, meaning downside, relative to the next best opportunity or your reward? Is it even, meaning do you have to risk $20 to make $20 in your best estimation? Do you like that? 1 for 1? Is it that there's 2 times as much risk as there is upside reward? A lot of these sectors, whether you're a fundamental analysis, a technical analysis, whatever you like to use, or a combination of both, if you look at it, most people are starting to find out that there is a multiple of risk relative to the reward. You won't like that. Why you want that? No, take your time, be patient. Let's find those opportunities at a time when more people are participating. It's going to get quiet for the rest of the year, so just a little bit of a heads up there, if I could give you a heads up. All right, let's go over to some stocks in the news here. Not much. I'll be honest, just a little bit of corporate changeover, some things happening here with stock buybacks, but I don't have a lot, so feel free to load up your questions. If you have any, I will take your questions, but let's do the stocks in the news, and then we'll go to your Guess the Dow leaderboard. First up, we got Ford there. Apparently a very expensive F-150 Lightning. People just aren't as interested. I don't know how to sugarcoat it. 50% less demand than they expected, and actually it was more than that. But they're going to cut production by 50% in 2024 because they're expensive. Why? There's a lot of competition out there. You tell me those are not cheap trucks. They're nice, but they're not cheap. Hasbro. The physical toys, right? So you think of the kids playing with their phones. They're not really, throwing around Barbies and things like that. The Wall Street Journal actually was the one that came out today and said 20% of their jobs are going to be cut purely because of weakness in the physical toys and physical games. That's their jam right there, right? And if people aren't playing Monopoly, right, and they're using their phone to play, do we still do Angry Birds? Is that a thing? Right? Obviously, it's a big difference there. They have a production component and everything like that, but still a little bit tough times there, so they're getting ahead of that, saying, let's do it. Prudential, not so tough times there. They're going to do a $1 billion share buyback there, but in 2024. All right, so they were just getting ahead of the curve, announcing that one. And lastly, you've got Waste Management. Not the most exciting stock ever. It is killing it. We happen to own it. I'm happy with the performance. They're going to raise the dividend. So they're at 70 cents right now. Tack on another 7% to that. Gets you just a little, it's a little bit higher, I guess. And they're going to buy back $1.5 billion of stock in 2024. Again, I would bring up, and I don't actually know the answer to this, what happened to the 1% tariff for stocks companies that are buying back their shares? I think it was a Biden thing when he first came in, maybe a combination of them, when they first took office, going, if you're going to buy back your shares, we're going to charge you a flat tax of 1%. That didn't do anything. These guys are like, forget it. Yeah, you can have the 1%. I don't know. Did they ever enact that or what? Someone help me out there, because I am not sure. All right, let's go over to the leaderboard. Hello.
I didn't know what to do. Yeah, you got your leaderboard. We got Slawomir,
Come on, man.
Porfirio, Tom, David, and Lawrence. I think 3 out of 5 of those people are clients, so good for them.
And 2 out of 5 have been winners, at least.
Yeah, I'd have to.
I'm thrown off by.
It might actually be 3. Yeah, it's probably 3 there, but yeah.
I'm thrown off by one of them, but I'm not entirely sure. If you want to play, jazzwealth.com/guess the Dow, you're watching these people consistently take your money. Give them some competition out there. And those of you that have played or do play can attest that we don't have a gimmick here. You just play. You know what I mean? I promise you, we will not be taking your information, selling it, using it, doing anything with it. And obviously, people would mention that if that was the case there. Swamp Rat says, cut the price of that F-150 by 60%. That's a great start. That would at least get me to look. Those are very expensive. Can't make a trip to the lake with the boat in the Ford Lightning. Ooh, some tough love there. So is it that the consumer can see through it? You know what I mean? One of our has become a friend of ours. He bought the all-electric Ford. It wasn't a Lightning, but it was an all-electric Ford truck. And I was like, okay. And I was just listening to him talk about it, and he was even skeptical. I'm like, that's a lot of money to not be sure, bud. But he's doing all right. If it needed to go through the house, it's a big day for financials today. Regional banks did not participate even last month. Any reason for that? Yeah, so actually the larger banks, remember, how to say it? The larger banks have many, many more sources of income. What's been picking up lately? M&A, right? Not a lot, I'll give you that. IPOs are basically nothing. And IPOs are done for the year. There won't be any. You have to have it in already. So there won't be any IPOs, no money there. They have M&A activity picking up. They've got their trading picking up. Where in particular? Bonds, right? Trading in the bonds market. They're making money there. Clients calling for making positions. Lots of transactions over there. And they don't have the same margins as they do in the general equity market, right? So they're making more money there. And then, of course, normal business lending, commercial lending, and investment grade lending. So they've got all that. Regional banks are really, they have some of that, but they've had to tighten up on their commercial loans. We saw with the Regions earlier this year. So they had to tighten up a little bit. They don't have as much of that margin coming in from the new higher interest rates, and they're sort of living on higher interest rates, but you can't expand that fast enough. Borrowing, remember, is like a third of what it was last year. I understand last year why there was so much borrowing, but it was about a third so far this year, and there's not much time to go. So you got the big guys that have multiple sources of income, just like people, right? They say, hey, multiple streams of income. Then you have the smaller regional banks, and even smaller, they're like, hey, we're kind of like waiting for someone to walk in and want to take a loan to buy a car, or they're buying a house or remodeling or something. So big difference there, which is why I use the XLF as my example today when I shared it there. Inflation Act of 2022 imposed the excise tax. Yeah, 1%. I know it was in there, but are they doing it? Because you see no mention of this anywhere. Did they figure out a way around it, and we just haven't figured out the trick yet? I mean, I know it's in the actual articles and the fully passed legislation, but you just figure you would see it on a balance sheet, something. Is the start of the 10% increase in stocks after the interest rates are cut. I don't know what you know what? Are you talking about? I think that was home prices though. And that was at the peak, not when they cut. If I can find it fast enough, that was a while ago. Home prices after cuts, or after the peak in interest rates, to show home prices actually rise. I don't believe we were talking about the stock market. And I'm already on slide 103. I have to come back to you on that one. Boy, some of these, I keep everything. Probably shouldn't keep everything. I don't want to keep you. Okay, I'll give it 3 more swipes. Oh, nope, sorry. I'll come back to you. I believe we were talking about houses, though. How do you think Powell will talk the market down tomorrow, or okay with the rally? Actually, Jerome Powell's turned around a little bit. His performance after the announcement has actually been net positive, not by much, but still net positive. Whereas when he started, it didn't matter what he said, the markets tended to fall. Remember, when the announcement is made, there's always the initial reaction, the refusal, and then the follow through after that. The day traders love that. That happens every single time. Doesn't mean it's going up, then down, then back up. Could go down, up, then back down. But that is the initial algorithmic reaction or whatever happens there. I don't know why they do that. You like the Lightning? Yeah. Well, actually, you know the one that I like? Somebody in my neighborhood got it. It's the Mustang SUV, Mach-E. It's the SUV look. That's pretty cool looking. I don't know what they cost, but I've seen that guy come and go just over the last week or so, last 2 weeks, and I'm like, it's growing on me. It was expensive. It probably $100 grand for something like that. I don't know, but it's electric, I believe. Yeah, I love it. Market timers are losing again. Well, so I'll take both sides of that now. Okay, so market timers lose when they go to cash, some form of cash, 20%, 100%, whatever it is. They go to cash in anticipation of the broad market pulling back. Those that have cash with the anticipation of some area pulling back, well, they have lots of choices. One in particular is energy right now. So they have places to potentially deploy money. That's one of the saving graces, I guess, for the market timer. If only a handful of the market is pulling the index higher. So there's maybe a little argument there. Whereas if we had 100% just full on breadth and every day everything was stair-stepping higher, oh yeah, you get left in the dust and you swear to yourself you're never going to do that again, and then it happens again, and that whole thing, like a diet. But when we're doing like this, it's a whole different story. I think you'll find a lot of people sort of getting away with it, maybe being taught a bad lesson there. But that's a different way to look at it than maybe you thought I was going to answer. Okay, I'll wrap it up there. We will get back to our business here. We'll see you again tomorrow. And then we got our Wine and Wealth on Thursday. We're going to talk about donor-advised funds, how the rich people use them, and then kind of boil it back to, okay, we're not them. Let's see how we can use them with smaller zeros and stuff and make some sense out of it where, hey, we get the advantage too, So we'll see you then. Thank you for watching and hanging out with us, and have a great rest of your night. When you wish upon a star, makes no difference who you are.